We don't believe that the Fed has to crush corporate profits.
The Fed is not the only one fighting inflation. We've talked a lot about the incredible Fed pivot that took place really about 4 months ago, where they moved from accommodative and easing to constraining and really attacking the issue of inflation. And that caused a major turning point in the market where we saw the worst performance of the equity and bond markets together really in history, where both of them fell by more than 10%.
We think that we're entering a new environment now where we're not going to see that strong correlation, where we're going to see if we're going to have a dour outlook, if the Fed were to over-tighten, the bond market is going to take some comfort in it. If instead the stock market is well supported by a careful Fed, bond yields could stabilize.
Obviously, what the Fed wants to do is to slow inflation, but it does not want to cause a recession. And it's going to try to do that through higher interest rates with a little bit of quantitative tightening.
We don't believe that the Fed has to crush corporate profits. The Fed has to crush the economy and shrink it down to make inflation work. But the problem here is the earnings estimates are still up 10% for this year and 10% for next year. And that's simply not going to happen.
One of the things we want people to realize is that the Fed is not the only one fighting inflation. One of the ways of fighting inflation is actually to have production go up. When supply goes up and consumer consumption goes down, that's anti-inflationary. And that's very important.
This is the best way we can survive this period without a collapse in everything in the economy, without a recession. Services are going up, services prices are going up. But if we combine all of this together, it's still pointing to a slowing inflation outlook.
We're not talking about the same type of bounce going into 2023 or 2024 that we saw in the pandemic. That was a once in a lifetime, God willing, event. And so we have to get used to this more conventional outlook that we had, by the way, all through 2015, really to 2020, where we had modest economic growth and different levels of profitability by industry. So we're going to have to be looking much more selectively at what markets and where we want to be as the cycle unfolds.
It's the reason why we're staying fairly strong within quality, within profitable companies, with companies with raising dividends, in industries that are well positioned to deliver, even if the economy stays slow. We have been generally wanting to avoid cyclical risk in the stock market because we think that peak upward growth momentum occurred last year. I've been saying this for a long period of time. Our one single exception, it's going to have to be an important part of our mid-year outlook, is that we believe there are commodity shortages. We think that natural gas for Europe is in short supply. We think that important fertilizers are in short supply. So these are things that we are going to overweight within cyclicals. But we generally, again, have liked this durable demand, that things that are essential services, healthcare, for example, rather than handbags.
So with all of that, we have a portfolio, as Stephen said, with about 11% of our total shares in both U.S. and non-U.S. dividend growth. And this has protected our clients from some of the downside that's occurred and exposes our client to the kind of upside due to quality shares that I think can do extremely well relative to a market that now is not going to grow as quickly as it did, certainly during the pandemic.